Good evening, friends. Very warm welcome to all the participants. This is my third year of presenting union budget proposals with Team Lacha, and I'm thankful to the founders, organizing committee, and all the viewers for viewing my session and listening to me. Thank you very much. In the session today, I will take you through some of the important proposals of Union Budget 2020, which were presented by our Finance Minister on 1st February in the Parliament. The agenda will be as follows. Firstly, I will take you through some of the measures government has taken towards welfare of women and children. These measures are likely to benefit to the society at large. Thereafter, we will discuss some of the measures or we will discuss some of the key tax proposals presented in Budget 2020. These will include the simplified optional personal tax regime, withdrawal of levy of dividend distribution tax, tax benefit extended to startups, increased tax cost of remittances outside India for tour, education, gift, etc. Change in tax residency definition and its impact to NRIs, and other important amendments. And towards the end, we will have time to take up any specific questions which you may have regarding Budget 2020. So please feel free to write in the comments box in the video, and I'll be happy to take up your questions and answer them. So let's start with measures government has taken towards welfare of women and children. In the budget speech, welfare of women constituted an important part in the budget speech of Finance Minister. Finance Minister stated that women self-help groups have been set up in villages. These groups have been titled as Dhanya Lakshmis, which will be supported by government's Mudra scheme and NABARD. These self-help group will operate infrastructure facilities such as agri warehousing, storage, reefer van facilities, etc. Thereafter, the finance minister shared success of Beti Bachao, Beti Padhao program. Gross enrollment ratio of girls across all the levels exceeded higher than the boys. To share specific percentage, at elementary level, the gross enrollment ratio of girls is more than 94% as against 89% for boys. At secondary level, it is more than 81% as compared to 78% for boys. And at higher secondary level, girls have achieved a level of almost 60% as compared to 58% for boys. So in a nutshell, at every level, enrollment of girl student is more than boys. To improve the nutrition status of children and women at large, the government had launched a Poshan Abhiyan program in 2017-2018. Under this program, children of age 0 to 6 years, young girls, pregnant women, and lactating mothers have benefited. This year, the government has allocated 35,600 crores for nutritional related program. A large portion of this corpus is likely to be benefited towards Poshan Abhiyan program of the government. Towards welfare of women, the government has specifically allocated 28,600 crores for all the programs that are specific to women. It is expected that the funds of 28,600 crores will be spent towards women-centric programs such as Beti Bachao, Beti Padhao, which caters to women education, Ujjwala scheme, which helps poor women to free themselves from smoke of wood, Pradhan Mantri Mudra Yojana, where women get affordable and collateral interest-free loans, and many other such programs. Moving on, one of the most important announcement government has made in Budget 2020 is about women's age of marriage. Women's age of marriage was increased from 15 years to 18 years in the year 1978 by amending Shraddha Act of 1929. The government realizes that as India progresses, opportunities open up for women to pursue higher education and careers. Just a minute, I think we're just facing some IT issue. Okay, no, I think it's fine. So I was referring to about the government's announcement of increasing the women's age of marriage. Uh, Currently, the age of marriage is at 18 years. The government realizes that as India progresses further, opportunities do open up for women to pursue higher education and careers. Furthermore, the entire issue of the age at the girl attains motherhood also needs to be examined. With this background, the government will set up a special task force, and the task force will give its recommendation about the change, if any, on the women's age of marriage. Once the task force is appointed, it will submit its reports to the government within 6 months. And on the receipt of the report, it is expected that the government may look to change the age at women's marriage, which is currently at 18 years. Once implemented, the amendment is likely to provide additional opportunities for women to pursue higher education or take up the employment and should definitely help towards women empowerment. Moving on, let me discuss the key tax amendments proposed in Budget 2020 and its impact on taxpayers. In this budget, one of the most important amendment proposed is towards simplification of personal income tax. It is proposed that an individual taxpayer and an HUF taxpayer will have an option at the year end to file at the time of filing of the tax returns to choose from the two available tax regimes. First is the old tax regime, currently which is applicable to all individual and HUF taxpayers. Under the current regime, a taxpayer is eligible to claim certain deductions and expenses from his total income. And once the expenses and deductions are claimed, the income thereafter is taxed at applicable slab rate. The current slab rate are as follows. Income up to 2,50,000 is exempt from tax. Income from 2,50,000 to 5 lakh is taxed at a rate of 5%. Income from 5 lakh to 10 lakhs is taxed at 20%. And income of more than 10 lakhs is taxed at 30%. So in the current tax regime, we have three different tax rates, which is at 5%, 10%, and 30%. In the new tax regime, which was announced by the finance minister, the government has proposed six different tax rates, which is at 5%, 10%, 15%, 20%, 25%, and 30%. And these benefit of these different tax rate will be available provided the taxpayer doesn't claim certain deductions and exemptions. So let us look at these tax rates with the closer details. What the government has proposed is under the new tax regime, income up to 2,50,000 will not be taxable. Thereafter, from 2,50,000 to 5 lakh, the income will be taxed at 5%. Then from 5 lakh to 7.5 lakh, the income will be taxed at 10%. Then from 7.5 lakh to 10 lakh, the income will be taxed at 15%. And from 10 lakhs to 12 lakh 50,000, the income will be taxed at 20%. And from 12 lakh to 15 lakh, the income will be taxed at 25%. And last slab, which is income of more than 15 lakhs, will be taxed at a highest rate, which is 30%. So fair bit of mathematics will be required for an individual taxpayer, as he will have to compute the income tax which he pays in the old regime vis-a-vis the new regime, and then choose the one which is more beneficial to him at the time of filing his tax return. So let us also analyze the situation vis-a-vis the different category of taxpayers, right? So first, let's take a simple case of a salaried individual. A salaried individual would need to make an election to govern from old or new regime. Assuming a salaried individual has income from banks fixed deposit, dividend from mutual funds and capital gains, and in some cases, the individual may also have income under head house property. If the individual earns only salary income, then she would be able to make such a determination at the start of the year. But it may so happen that she may be earning variable income, which is say dividend or income from units of mutual fund, capital gains, or rental income from house property. These variable income may ultimately also impact or determine which regime the individual should opt for. For example, uh, if let's say the employer has made a condition that the employee needs to make an election of the regime which he wants to choose at the start of the year, because the employer would have such a condition so that they can withhold tax at an appropriate rate, then at the start of the year the salaried individual will have to make a determination of taxes which he ought to pay if he would choose an old regime vis-a-vis a new regime. Then during the year, if he receives certain variable income, such as dividend income or income from units or capital gains on sale of shares or units of mutual fund, then he needs to make an assessment again if there is any change in the regime which he is required to make. And lastly, when he is filing his tax return, he has to again do the computation in both the regimes to make a final choice of which regime he should elect for in the tax return which he is filing. There are certain important points a taxpayer needs to keep in mind before making an election about the new regime. Under the new regime, various exemptions and deductions and set off of losses are not available. To give you an example for the leave travel concession, the house rent allowance, standard deduction for salaried taxpayer and deduction for professional tax, interest which is paid on housing loan on self-occupied property, and set off of losses under the head house property, and various deductions under chapter 6A, which includes deduction for medical premium under section 80D, deduction towards donation under section 80G, and investment linked deductions up to 1,50,000. These all deductions will no longer be available if the taxpayer chooses to be governed by the new regime. Another important point to be kept in mind is this regime is not only applicable for individual taxpayers but also for HUF taxpayers. So if we have an HUF who is earning interest income or business income, then the HUF taxpayer is also in a position to elect or opt for the new tax regime if such tax regime is more beneficial to him. The final choice to make an election is at the time of filing of the tax return. And once the tax return is filed, the income tax authorities will assess the income based on the regime which the taxpayer has opted. If for some reason the taxpayer chooses the new regime and it so appears that he is not eligible for such a regime on account of deductions if he is claimed, then the tax authorities have a right to assess him under the old regime. Importantly, if an individual in HUF who's earning a business income has opted to be governed by the new regime, and thereafter in the subsequent years they make an election to opt for the old regime, then they will not have a flexibility again to be governed by the new regime. To give you an example, if let's say an HUF who has a business income opts to be governed by the new regime at the timing of filing of the tax return for financial year 2020-2021. Thereafter, at the time of filing of the tax returns for financial year 2021 and 2022, he opts out of the new regime and files his tax return under the old regime. Then, from financial year 2022-23 onwards, he will not be eligible to be taxed under the new regime unless he ceases to have any business income. The above restriction is only applicable to individuals in HUF earning business income. The other individual and HUF taxpayers have the flexibility to opt in and opt out of the new tax regime. To summarize, while the amendment will govern the personal taxation for financial year 2021 and 21 onwards, it lays out the path the government would like to progress in governing personal income tax matters in India. In other words, if the government observes that the taxpayers are opting for the new tax regime at large, then in the coming years we could soon have a tax regime whereby the deductions and various exemptions which are currently available will be withdrawn by the government. Example, deduction for mediclaim, donation, house rent allowance, set off of loss under head house property, or investment linked deductions such as PPF or payment towards school fees of children, investment in PPF, National Savings Certificate. All these could be withdrawn in the future if by and large the taxpayers opt to be governed by the new tax regime. Moving on, another important amendment which is proposed in this budget is removal of dividend distribution tax. Currently, dividend distributed by Indian company to its shareholders are subject to dividend distribution tax at the rate of 20.56%. Thereafter, dividend which is distributed by shareholders is not further subject to any tax except in case of a super rich taxpayers, for which the super rich shareholders, which earn dividend of more than 10 lakhs are subject to additional tax at the rate of 10%. In this budget, it is proposed that the levy of dividend distribution tax will be withdrawn and the dividends so earned by the shareholder will be taxable in its own hands. Further, the Indian company which is distributing the dividend to the resident shareholder will deduct TDS at the rate of 10% if such dividend income exceeds 5,000. And similarly, if the dividend is distributed to a non-resident shareholder, they will deduct the tax at an applicable rate or a lower tax rate prescribed into the tax treaty if the shareholder is eligible to claim treaty benefits. Removal of dividend distribution tax may help the company to declare larger dividend, and one would hope that this would result in additional flow of funds in the hands of small shareholders in form of additional dividend. Having said that, for rich shareholders, the computation or suggests that they may end up paying higher income on the dividend income which they earn from the company. Another important amendment they've made is the deduction for any expenses which they earn on the dividend income, specifically payment of interest, has been capped at 20% of the dividend amount, which means deduction will be allowed to the shareholder only in respect of interest income, and that too with an overall cap of 20% of dividend income only. Similar amendment they have also made on income which is distributed by mutual fund houses, which means the income which a taxpayer receives in form of dividend from a mutual fund will now be taxable in the hands of the unit holder and will no longer be exempt, whether it's a income from an equity oriented scheme or debt oriented scheme. No change in the tax rates have been proposed for corporate corporate companies and LLPs. Moving on, a new simplified optional tax regime is also provided to cooperative societies. A new provision has been introduced which provides an option to resident cooperative societies to either pay corporate tax at a lower rate of 25.17% instead of the current rate of 34.94%. With this amendment, the taxation of cooperative societies is brought in line with that of a domestic company. However, the benefit of a reduced tax rate to the cooperative society will be available provided the cooperative societies doesn't avail certain deductions such as tax holidays, additional depreciation, investment allowance, and other investment linked deductions. And unlike in personal income tax, where an individual and HUF had an option to opt in and opt out of the regime, for cooperative societies, it is proposed that the option to apply for this regime can be exercised in the return of income for financial year 2020-21 onwards. And once the option is exercised, it cannot subsequently be withdrawn. So it is very important that a cooperative society makes an assessment in advance and chooses whether they prefer to be governed and taxed by a higher tax rate or avail benefit of a lower tax rate and give up the deductions which they otherwise are eligible to. Moving on, a very important amendment they have proposed is in changes of tax residency rules of an individual. These changes are very significant and requires an analysis on an individual basis to examine if there is any India tax exposure the NRI is subject to because of this amendment. To explain you, currently the Indian citizens and person of Indian origin who come to India on a visit had an extended period of 182 days of stay in India before such individual could be treated as a resident from an India tax perspective. This period of 182 days is now proposed to be reduced to 120 days. As a result of an amendment, an individual who is residing in India for more than 120 days is likely to be treated as a resident of India. And in the event, if such an individual also qualifies to be an ordinary resident of India, then her overseas income will be taxable and she will also be required to disclose their overseas assets in her India tax return. So going forward, it is very, very critical for an NRI to keep a log of travel or visits in India to ensure if the NRI wants to be treated as a non-resident, his or her stay in India should be then less than of 120 days. Another change which they have proposed is in a particular situation, irrespective of the number of days the Indian citizen spends in India, he could be treated as a resident of India of the relevant financial year if he is not liable to pay to tax in any other country on account of his domicile or residency. In other words, if an individual who's a citizen of India who is not a resident of India because of his number of days are less than 120 days and is also not liable to tax in any country outside India, then such a person will be deemed to be a resident of India. When this amendment was proposed in the parliament, it immediately created a fear in the minds of NRIs staying outside India, and specifically for those NRIs who are working or staying in countries which do not have any personal tax system. The question which had arisen was whether such NRIs, example, the individual staying in Middle East, say Dubai, does not pay any taxes in Dubai, whether he will be deemed to be a resident of India by virtue of this amendment. Immediately after the budget, the government thereafter issued a press release and has clarified that individuals who are earning income in Middle East should not be impacted out of the proposed amendment. The government also clarified that the intent is to tax an individual who is not liable to tax in any country in the world. For example, there could be individuals who would have traveled various countries around the world in a particular financial year, and he would have structured his travel in a manner that he is not a resident in any of the countries. This amendment is to impact or will impact these individuals who are not a resident of any country in which they have traveled. For NRIs, another important point which they need to keep in mind is they will need to maintain some sort of documentation to substantiate their country of tax residency. For example, certificate of tax residency if the country of residence and domicile issues such a certificate, or a permanent residency card along with number of days which they spent in that country, or a copy of their tax return. I would believe these documents would help substantiate that they are liable to tax in the country of their residence and therefore should not be treated as a deemed resident of India under the above deeming provisions. Moving on to the last amendment which they have made in the tax residency rules. Under the current tax residency rules, after it is determined that individual is a resident of India, there is a secondary test. Under the secondary test, an assessment is made whether an individual qualifies as an ordinary resident or a not ordinary resident. In this test, they have made a change whereby an individual will be treated as a not ordinarily resident provided he is a non-resident of 7 out of the past 10 financial years. Under the current regime, if an individual had to be a non-resident for 9 out of past 10 financial years for him to be treated as a non-ordinarily resident. Under the new regime, they have relaxed this condition from present 9 years to 7 years, which means an expatriate or an individual who's returning to India after staying in outside India for many years, the individual could potentially become an ordinary resident for the first time from the fifth year onwards, as against the third year year onwards, which used to happen under the old regime. So this to summarize, the changes in the tax residency rules for an individual are very likely to be impacted to all the NRIs. And from their side, it is very important. A, they maintain a travel log of number of days spent in India. These number of days will include whether they travel for work or personal visit. Second, they will have to maintain certain documentation to which will kind of substantiate their country of tax residency. And third, the log of the travel days is required not only of the year in which they are filing the tax returns, but also of prior 10 years. Moving on, let me discuss the changes which they have proposed in the budget, which governs the taxation of startups. There are two important changes which they have proposed. One, conditions, they have rationalized the conditions which are applicable for tax holiday to a startup. And second, they have given relief in ESOP taxation of startups. Currently, a tax holiday is provided to an eligible startup having a turnover of less than 25 crores for 3 consecutive years out of the 10 years beginning from the year of incorporation. Again, this 100% tax holiday is available subject to certain conditions. In this budget, they've rationalized two conditions. A, the tax holiday, which was available for 3 consecutive years out of the 7 years, they've extended the period from 7 years to 10 years. What it means is the government has realized that the startup is likely to have losses in the initial years of operations. That is why, to claim the tax holiday, instead of 7 years, they have given 10 years to the startup. So once they choose a particular year on which they want to claim tax holiday, then for the next 2 consecutive years as well, they will be eligible to claim 100% tax holiday. These 3 years they have to choose from the 10 year from within 10 years from the date on which they are incorporated. Second condition which they have relaxed is the threshold, which was kept at 25 crores for an entity to be treated as a startup. They have increased this threshold to 100 crores, which means as long as the turnover of the startup is less than 100 crores, as long as the turnover of a company is less than 100 crores, that company is likely to be treated as a startup and will be eligible for 100% tax holiday, provided they meet the other conditions which are specified under the tax laws. Another important amendment which they have made is on the perquisite taxation on ESOP, which is provided to an employee of a startup. Under the current regime, if an employee stock option plan is provided to an employee of a startup, a tax on perquisite is required to be paid when the option is exercised, and thereafter, whenever the shares are sold, the difference between the exercise price and the sale price is treated as a capital gain and tax is paid on the year in which the shares are sold. It was believed that this structure of taxation of ESOP was providing cash liquidity not only to the startups, which are the employers, but was also leading to tax issues for the employees. So in order to ease the burden of tax, this budget proposes deferment of ESOP taxation by 5 years from the end of the financial year in which the option is exercised, or the year in which the employee ceases to be an employee of the startup, or till he sells the shares, whichever is earlier. In simple words, this benefit should A, help the employee in paying tax upfront when the option is exercised, and B, should also help the employer in managing or in perquisite taxation, and should help reduce the working capital which would otherwise be blocked in form of tax on perquisites. Moving on, another amendment which they have made is in variation of tax treatment of employers' contribution. Currently, Employee Provident Fund Scheme, National Pension Scheme, and Approved Superannuation Fund, these are the three most prevalent employer-funded retirement schemes which typically most organizations have. The employer contribution to these schemes is currently not taxable in the hands of the employee, which means if 12% of the eligible salary of the provident fund, 10% in case of eligible salary for national pension scheme, and 1.5 lakhs towards approved superannuation scheme, all these payments made by employer to the account of the employee were not taxable in the hands of workers. There was no combined limit for upper limit, no combined upper limit for the purpose of deduction. There were individual limits for all the contribution, but there was no combined upper limit. In this budget, they have proposed a combined upper limit of 7,50,000 in respect of employers' contribution in a year for all these three schemes. Consequently, it is also proposed that any annual accretion by way of interest, dividend, etc., earned on the accumulated corpus should be treated as a perquisite to the extent it relates to such employer's contribution which is taxable in the hands of individual. Which means excess contribution is taxable and income on such excess contribution is also taxable. Moving on, deduction in respect of interest on purchase of affordable housing loan, which was only available till 31st March 2020, has now been extended by one more year. In other words, an additional interest deduction of 1,50,000, which was available to individuals in respect of loan obtained for a person for purchasing a residential house property, where the stamp duty value of such property was less than 45 lakhs. Such additional interest deduction of 1,50,000 will now be also available for financial year 2020 and 2020-21. Another important amendment which the government has made is towards rationalization provisions relating to Form 26AS. Currently, the income tax system prepares and delivers a form which is called 26AS to every taxpayer, and in this form, an individual gets data of the TDS which has been deducted under his PAN and prepaid taxes. It is proposed in this budget that instead of Form 26AS, the government will prescribe a statement of financial transaction which a taxpayer has entered into in a particular financial year. This statement of financial transaction will include information about TDS, it will include information about advance tax paid, it will include information about immovable property purchased or sold by that taxpayer. And in the coming years, it may also include information about donation made or information about equity shares or units of mutual funds which are sold by the taxpayer. This annual statement should help the taxpayer in computing his total income for a particular financial year and will also help the government to compare the information which is reported in the annual statement vis-a-vis the information which is reported by the taxpayer in his tax return. Another important amendment which the government has proposed in this budget is tax collection at source in respect of foreign remittance through liberalized remittance scheme or on buying of an overseas tour packages or on sale of goods above specified limits. Let me give you a background of what is tax collection at source. Viewers would be familiar with tax deduction at source, which involves whenever a taxpayer is receiving certain income, the payer of that income will deduct TDS. A common example is interest on bank's fixed deposit. When banks pay interest to the deposit holder, TDS is deducted at a specified rate if the interest is exceeds a particular limit. This is commonly known as TDS. Under the income tax law, there is a concept of tax collection at source, where an entity sells certain goods or enters into certain transactions with the counterparty. In addition, for the payment towards the sale consideration, the entity will also collect certain tax from the buyer and deposit this tax with the government. A common example is when an individual is purchasing a luxury car, the car selling company collects tax from the buyer, and this tax collects tax at the rate of 1%, and this tax of 1% is thereafter deposited with the government under the PAN name of the buyer of the car. In this budget, it is proposed that such tax collection at source will also applicable where an individual is remitting funds outside India under the liberalized remittance scheme. Such tax collection at source will be at the rate of 5% if the remittance under the liberalized remittance scheme is more than 7 lakhs in a particular financial year. A common example of remittance under liberalized remittance scheme includes remittance towards medical facilities which a person takes outside India, payments towards education of children, or gift to relatives outside of India. All these transactions going forward will be subject to additional tax at the rate of 5%. Thereafter, the seller of an overseas tour program package is also required to collect tax at the rate of 5% whenever he collects any amount from the buyer purchasing the package. In simple words, if you're opting for an overseas tour package for travel outside India, say Europe, and if you approach any tour operator or a travel company, in addition to the cost of the package, they will take 5% from the traveler and pay this 5% under the PAN of the traveler to the government. In this regard, they have defined the word overseas tour program to include any tour package which offers visit to a country or countries outside India and includes expenses for travel, hotel stay, boarding, lodging, or any other similar expense. Additionally, if the traveler does not furnish his PAN or an Aadhaar, the rate of TCS will increase to 10% instead of 5%. So it is very important for an overseas traveler to keep this in mind and provide his PAN or an Aadhaar number to the travel operator or travel company, and to also budget for additional 5% for the tour package. Another very important amendment which they have made is they have proposed to levy tax collection at source at the rate of 0.1% on consideration which a seller receives from a buyer where such amount is more than 50 lakhs. Also, this provision is applicable only if the total sales or gross receipt of the seller is more than 10 crores in a particular financial year. In simple words, what it means is, if there is an exporter of goods and such an exporter has a turnover of more than 10 crores in the immediately preceding financial year, then in the current financial year, if he's selling goods to a buyer of more than 50 lakhs, then in addition to collecting sale consideration, he should charge additional TCS of 0.1% to the buyer of the goods. And where the buyer does not have a PAN or an Aadhaar, the tax rate should be 1%. To me, it appears that this amendment has not been thought through enough. This is likely to impact all the exporters at large, because most of the exporters who are selling goods to purchasers outside of India do not have any PAN or an Aadhaar. And if the buyer of the goods does not have a PAN of an Aadhaar, they will have to factor in 1% of the selling price and in a way compromise on the pricing of their goods and may also be less competitive when the buyer is going to compare rates with the sellers, with the other sellers which are operating in other countries which do not have such similar levy of tax collection at source. One would hope that the government looks through this amendment once again and issues a clarification whereby genuine exporters are not impacted. Another important amendment which the government has made is towards tax audit requirement. Currently, if the turnover of a taxpayer is more than 1 crore and the turnover is more than 50 lakhs in case of a professional, he or she is required to get its accounts audited by a chartered accountant. This limit of 1 crore is proposed to be increased to 5 crores provided the cash receipts and cash payments are less than 5% of total receipts and total payments. Other important amendments which have been introduced in this budget is around dispute resolution scheme. The scheme is titled as Vivad se Vishwas scheme. This scheme is essentially introduced for settling direct tax litigation. In this budget, it is proposed that the taxpayers would be required to pay 100% of the disputed taxes by 31st March 2020 under this scheme. And once they pay the disputed taxes, the entire waiver of interest and penalty will be available. Where the dispute relates to penalty or interest or fee, the taxpayers would be required to only pay 25% by 31st March 2020 for settling the disputes. In case if the payment is made after 31st March 2020, the taxpayer will be required to pay 100% of the disputed tax and 30% in the case of penalty or interest. This scheme will be open till 30th June 2020. The government very recently has also laid out the scheme, which kind of gives granular details of how the scheme can be availed. Thereafter, government has increased the safe harbor limit for real estate transactions. In simple words, if the difference between the stamp duty value and the sale consideration value is at 5%, then there is no addition to the total income of the taxpayer. This limit of 5% is now increased to 10%, which means if the difference between the stamp duty value and the sale consideration value, as long as it is less than 10%, the assessing officer cannot make any adjustment to the sale price of the real estate transaction. Furthermore, they have introduced an additional reporting requirement to all the donees, which is the charitable trust and institutions, to give details about the donors to the income tax department. Thereafter, the trust will have to issue a certificate of donation to the donor, and this certificate the donor can use to report the details of the donation which is paid in his individual tax return. Moving on, the existing scheme of faceless assessment is now also extended to appeal proceedings before Commissioner of Income Tax and for penalty proceedings. With this, taxpayers has a faceless assessment mechanism of scrutiny assessment, penalty proceedings, and of Commissioner of Income Tax appeals. Additionally, the e-commerce operators are required to withhold tax on payment which they make to e-commerce participants at the rate of 1% on the gross value of the product. This additional TDS rate of 1% will increase to 5% if the e-commerce participant does not provide a PAN. However, they have also given a relief that no TDS is required if the e-commerce participant is an individual in an HUF and the gross sales is less than 5 lakhs and he provides a PAN or an Aadhaar to the e-commerce operator. This additional 1% TDS will be deposited by the e-commerce operator on the account of the e-commerce participant, and thereafter this e-commerce participant can claim the credit of this 1% TDS at the time of filing of his tax return. To this, we come towards the end of my discussion or about Union Budget 2020. Some of the proposals, my personal view, some of the proposals which the government has announced in this budget, like the personal income tax regime, change in tax residency rules, is going to have a larger impact on an ongoing basis. This should definitely help government in administering these type of in these tax regimes in a specific manner, especially on the individual tax front. In the coming years, if the individual chooses to opt for a simplified regime, we're going to see minimum of disputes between the taxpayer and the tax department. Also, the amendment to introduce tax collection at source on specified payments should help the government in collecting information about specified transaction, and the government thereafter could use this information to examine if there is any tax avoidance by the individual or by the company. With this, we come towards the end of the session. I would like to thank viewers for your time, and I hope I was able to provide you a perspective about the Union Budget 2020. If any of the participant has any specific questions, I'll be happy to take them up. I'm also available on my Facebook account, and after this session, also participants has any question, feel free to drop a message on my FB account, and I will be glad to answer that to you. We have a question from Dr. Kalpana Chimitra. How this budget affect professionals? Well, from looking from a professional, let's assume the professional is an individual. Then the key impact areas are: one, the individual professional will have an ability to be governed by the new simplified personal tax regime, which, as I said, under the new regime, the individual will not be eligible to claim any deductions, but at the same point of time, will can take benefit of the different slab rates which has been provided. So that is one kind of impact area for the professionals. Second impact area, if the professional is traveling outside India for work or for a vacation and is making any payment for the overseas tour, then an additional TCS of 5% will have to be kept in mind. This is largely a working capital issue for the professional. Third important amendment for the professional should be again tax collection at source on any payments they are making to for education of their children outside India, or for medical relief, or to give to a family member outside India. Uh, I would think by and large these are the key tax proposals which was likely to impact a working professional. Any other questions? I'm happy to take up. I think this is it. So with this, we finally come to an end. Thank you so much for patient listening. And once again, a big thank you to the founders, organizing committee, and to all the participants. Have a good day.